Housemasters, the hard knock school of everything new construction and remodeling, powered by Home Projects. Now introducing the Home Projects Housemasters, Steve and John with an extra credit lesson, Profit 101.
Welcome to Housemasters, presented by Home Projects. I'm Steve and this is John, and we're here for a special extra credit lesson on profit. Before we get to that, John, I'm going to let everybody know that we asked them to subscribe to our channel and hit like at the bottom of our page. And while you're at it, hit the little bell down there that YouTube has created so that when we push new content, you'll get a push notification or an email. That way you'll be able to keep up to speed with what we're doing. We also ask that you make a donation to our cause. Without your generous support, we will not be able to continue with this educational platform that you will be enjoying over the coming months and years. So John, this is Profit 101 for professionals. What is profit?
Well, profit is one thing it's not is wages. And the thing that we're going to talk about tonight is profit for the professional contractor versus your Dan in the van or Buck in his truck who literally thinks that his wages are his profit. And we're going to show you the difference between the two models.
Okay.
And how one is sustainable and the other is not. The first thing we will need to talk about, before we get into the crux of it though, is, what is a business? Business, defined by Merriam-Webster is the activity of making, buying, or selling goods or providing services in exchange for money. Okay. So any entity that is going to provide a good or a service in exchange for payment of some sort can be classified as a business. Okay. That is in major contrast to what is a job. A job is when you share your particular skill set in exchange for money. Okay. But the business creates a completely different dynamic compared to somebody that's looking for a wage.
Right.
In terms of business, you have two types of businesses that we're going to talk about tonight. One's a nonprofit, not very common in our industry, but you've got some out there, like your what are some of the charitable organizations?
Habitat for Humanity.
Habitat's one. You got some other ones, for like tiny houses and stuff like that.
That's right.
But we're the general idea of what we're focusing on tonight is your for-profit business. And a for-profit business is a model that drives the economy, plain and simple. Without business activity, there would be no economy. And you could probably say there'd be no business if there wasn't an economy either. So
that's an episode. That's a discussion for another day.
It is. But again, we're going to focus on the for-profit.
Okay.
The next thing we need to define is what is revenue. Revenue is income earned by a company for selling its goods and services. So in other words, we've already determined that a business is trading goods or services for a particular payment. And then that payment that is derived from those goods or services is classified as income or revenue.
Revenue. And so income and revenue can be used interchangeably in most instances.
Exactly. Okay. Then we've got, and this is where the big misunderstanding comes from most of the time, a number of misunderstandings actually. Cost of goods sold. Okay. We call it COGS. Okay. COGS. Cost of goods sold it refers to the direct cost of producing the goods sold by a company. This amount includes the cost of materials and labor directly used to create that good or service.
So for instance, if someone hires you to replace a window, what is the cost? What part of that job would generate a COG?
Any cost that is created from that particular project. So in other words, the window, your caulk sealant, shims. If there's damage around the window, you might have slight costs in lumber, silicone, and then obviously your labor. And then when I say labor, I'm speaking of not only labor, but labor burden as well. And what I mean by burden is you've got your payroll taxes as well as your workers' comp that you have to account for. Okay.
Yep.
So on average, in your remodeling business, I would factor in roughly anywhere between 12 and 17% burden, depending on what state you live in.
Per person on the job site.
Exactly.
And in some cases, not necessarily on the job site. If you've got some other people working in the background, they also have burden too.
Yeah, well, then that's when you start getting into your indirect costs.
Yeah.
And that's where even further misunderstanding comes in, because again, your COGS are going to be directly related to the actual job itself. Okay. You have marketing, say, but yeah, you could technically say that part of your marketing got you that job, but still it's more of an indirect expense.
Correct.
That isn't included in the COGS figure. Let's talk about some other indirect costs. Liability insurance. Liability insurance is something, for a professional contractor, you're going to pay that regardless of how many jobs you have. Rent, utilities, vehicles.
Yep.
Your vehicle is going to go to every job. So there's no way of putting it towards a particular job.
Now, what if they have a line item in their budget for a truck? Let's say it's the F-150 with a certain number of tools in it. Would that be considered a cost of good, or is that still an indirect cost?
I've always done it as an indirect cost. You have discussions that have been had and debates for years as to whether you can item that stuff out. Yeah, but that's a different episode. Just for purposes of what we're talking about tonight, we're going to classify it strictly as an indirect.
Okay.
Office and support employees. So if you have an office manager, if you have a receptionist, if you have a superintendent for the job, and he's covering 4 or 5 different jobs. Now, in that particular occasion, you could create a scenario where if he's covering 4 jobs at a time, at all times, you can divvy up his labor burden by those 4 particular jobs. The other thing is a lot of times with smaller companies, you'll have the owner of the company will be on the job.
Yeah.
If that's the case, that owner's labor has to be taken into account, plus the burden on that labor, if there is any. Okay. A lot of states don't require a workman's comp cost on the owner. Some states do. But in terms of indirect costs, most of the time, if you've got a crew that you're sending out and you're the owner of the company and you're not on the job site, you're an indirect cost. The other big one is sales commission. If there's a sales staff that's selling that job and they're gaining commission off of it, it is a indirect cost.
Yeah.
Just as any salary that would be paid to that particular salesperson. But let's go back to what I had said earlier. There's a huge difference between somebody saying they're in business and using their particular wage as their profit, and a professional business owner who knows what gross profit is and can separate that out from the particular wage itself. So in other words, when we talk about gross margin and markup and everything else, we're talking about something over and beyond the actual cost itself.
Correct.
So in other words, in a particular scenario, and let's just take a window again, just to your example, because it's pretty basic. You've got your window, you've got your all your ancillary costs like your caulk, your, silicone, your shims, your lumber, whatever you might have, plus you have that particular labor in that particular job. If you have a subcontractor now, it's most of the time pretty easy because they're giving you a flat rate per window, and then you're just putting a margin on top of it. But when you have an employee who is on staff, it gets a little bit murkier because you're having to apply that particular burden of workers' comp and payroll tax to that particular window, and then extrapolate that out to however many windows you've got on that particular job. Okay. So those are your direct costs again. And your margin is going to come directly off of that particular direct cost. Okay. That's why we call it a gross margin. Okay. You have a gross margin, and at the end of the day, you have a net margin.
Yeah.
Okay? And the net margin is derived from when you apply all your direct costs after the fact. So what is a markup versus what a margin is? Okay. A markup, and this is something that's also always confused, is the retail price for a product minus its costs. Markup is the percentage amount by which the cost of a product is increased to arrive at a selling price. Okay. Now, let me get back to your screen there, Stevie.
Stevie. You shouldn't call me Master Stevie.
Home Master Stevie. The formula that we've got here puts it pretty clear. A markup percentage equals your sales price minus unit cost over unit cost times 100. Now, an easier formula for that would be your cost or COGS.
Yeah, times 100%.
Times, well, if you want a 100% profit margin, yeah, you'd go times, actually you'd go times 2. If you want a 30% markup, you would take your COGS and multiply that by 1.3. And then that 1.3 difference is going to give you your actual margin.
Right.
Or your markup in this particular case.
And you have to be careful because you have to multiply it by 1.3, because if you multiply it by 1/3, then all you're doing is taking your cost and dividing them by 1/3. And that's going the opposite direction unless you do some additional math after that. But on the screen, you can see the chart says sales price minus unit cost over unit cost times 100. So if you're into algebra, you know that the unit cost on the numerator and the unit cost on the denominator actually cancel each other out. And so if that's the case, then you take out the times 100. But we're not in a math discussion here.
No, and I'll be honest with you, I was never a math whiz as it was, so I'm big on simplifying.
Yeah.
And when I mark up something, I take my costs and I multiply it by the actual markup that I want. So if I want a 25% markup, I go cost times 1.25.
Yep.
And that's the easiest way to derive it.
That's correct. So markup is literally the money you make on top of the cost of the good that you sell to your client. Exactly. Almost think of the sales price as the wholesale price, what you're paying for it, what you paid for that window when you went and bought it from your supplier, plus the caulk and the sealant and all the other stuff. And then you multiply that times your percentage to get what you're making on just that window.
Yep.
Okay. Trying to make sure it's as simple.
Now, profit margin. Profit margin is going to refer to the revenue a company makes after paying the cost of goods sold. Again, COGS. Cost of goods sold is COGS. Any revenue left over after covering the expenses of providing a good or service. Okay. So how are we going to calculate that? We're going to take gross margin is going to equal total revenue minus the cost of goods sold, your COGS, over total revenue times 100. Now, again, I always simplify when I figure my margin. If I want a 30% margin on a product, or if I want a 30% margin on a product or a particular service that I provide, 30 from 100 is 70. So what I'm going to do is I'm going to take my cost, my COGS, and I'm going to divide it by 0.70. And that's going to give me a 30% margin. A professional contractor in this business is always going to yearn for at least a 50% profit margin. Okay. And with a 50% profit margin, it makes it easy. So what you're going to do is you're going to take your COGS and you're going to divide it by 0.5. Your professional contractor out there is going to, at the minimum, always try to derive 50% profit margin on a job. Okay. 50% profit margin is extremely easy in the formula. It's your COGS divided by 0.5. Okay. Which gives you a 50% margin. So if your cost on a particular product was $25 and you divide that by 0.5, it's going to give you a selling price of $50. Interesting that you see that a 50% margin is also a 100% markup. So you could as equally take $25 and multiply it by 2, and that will give you a 50% margin. Any questions, Steve?
No, it's pretty simple. I think the biggest mistake people make is not marking up their labor and relying on their labor, their hourly wage, as their profit, and that's part of the cost of good. And unfortunately, sometimes you're competing with contractors who are making that mistake, and they come in much less expensive. And that's where you get into the difference between a professional contractor and one who's actually running a business for profit. So,
yep. And I'll add, you don't know how many of these Facebook groups that I'm a member of that are actually supposed to be filled with professional contractors. And a lot of them are. But I'll ask them, they'll say, well, what do I need to sell X for? I'm new to this particular trade. It's the first time I've done a floor before. And they'll say, well, usually I take material and multiply it by 3.
Yeah.
Well, what does your material cost have anything to do with your actual labor cost? So in other words, if you were going to take 3 screws and your job was to screw those 3 screws into the wall,
and
a screw costs you 2 cents.
I was going to say, so you're going to have 6 cents in cost of goods, and then you double that, so now you're up to 12 cents. So you only made 6 cents on the job?
It makes no sense at all. I mean, your material cost has no correlation whatsoever to your labor cost.
And I think that's where a lot of people oversimplify by saying materials times 3, assuming that times 3 takes care of all the direct costs and indirect costs that you see on the screen here. They don't know their business well enough to know how much the guy cost, how much the screwdriver cost, how much it costs to go get the screws from the hardware store. So rather than know your numbers, they just multiply by 3 and hope it covers.
Well, it never fails when I see somebody post something like that. I always follow it up with a question. Can you tell me what your margin is based on that particular formula?
And they can't.
And I never receive a response. Right. Or if they respond, well, I've been doing this for 25 years. I've done pretty well for myself. No, you haven't. If you've been doing that for 25 years, you've been doing it wrong, and you should be retired by now.
Yes.
With all the money that you've been leaving on the table.
Yeah, you and I are big fans of the show Shark Tank, and they always say on Shark Tank you have to know your numbers. And if you can't go into a job at the end of the job, and even day to day, be able to tell your partner or whoever might be interested in what you made that day, what your burden was, what your overhead was, It doesn't have to be down to the nickel and dime, but having a general idea of what it costs every day to open your doors and go to work. You can't do this math up here without knowing those numbers. And that's really what this extra credit's all about, is making sure you understand that that's the professional way to do business, is to know your numbers.
Now, let me add something into this, okay? And this is where it gets really murky when you're dealing with in-house employees, okay? When you've got a subcontractor that you're working with, it's cut and dry, because he's going to give you a cost. Usually it's a piece cost, per square, per square foot, whatever it might be. But when you've got an in-house employee who's on the clock, who's working 8 to 10 hours a day on your behalf, it's extremely important that you account for these particular numbers correctly. Okay. Now, on one day, that particular employee could be putting a window in. The next day, if your business is set up this way, he could be up on a roof. Well, the difference there is the cost for workers' comp on a window install
It's very different
versus a roof install is like 3x in some states.
Yeah, 3 times.
I mean, a window install, I think I was, at the time, I was paying $9.88 per 100 payroll. Whereas if I did a roof, I was paying $24 per 100 payroll. So obviously I always used a roofing subcontractor who'd give me a square price, and I would just put my, margin on top of it. But so you have to really watch that, because you do have to factor in, different types of trades that you're doing on that particular job if you have an in-house crew. And you have, there's some employees out there that have the skill set where they can do multiple trades. But again, I stress, the handyman industry of our industry is actually notorious for this. And you can call them, I don't care, you can call 20 of them out of the phone book or off of Google, and they'll tell you, well, yeah, I'm $25 an hour. Well, I mean, that's just, that dude has no profit whatsoever.
That's right.
Whatsoever. That $25 is beer money.
Yeah, that he's selling his, in that particular model, he's selling his labor as his profit.
Exactly.
There is no margin. There's no gross margin at all. And clearly no markup. It's basically a cost plus. He's taken the cost of his materials plus his time, and he's selling it to you. That's where you start losing money.
Well, and what he doesn't realize is there's only so many hours in a week.
Right.
So in the best case scenario, at $25 an hour, I mean, let's just say he works 40 hours a week. Okay. He's going to make what?
Nothing.
Well, I mean, he's going to make his wage, $25 times 40.
Yeah, but by the time he covers his insurance, his overhead, and all the other things that come out of that.
Right. I mean, he's going to make $52,000 a year at the minimum.
Yeah, which is,
or actually at the maximum.
Maximum, and then of that, taxes. He's probably taking home $12,000 or $13,000 a year at that rate.
And what's worse about it is, as well as I do, a handyman guy that's working on his own, he ain't working 40 hours a week. He's working 60 hours a week.
Yep.
So he's not even paying himself a premium for his overtime time.
Correct. And he's not getting covered for travel between jobs.
No.
And any office time, he's, and for invoicing time or so forth. So that's the point of all this. It's okay if you don't really understand the difference between margin and markup and gross margin. It's okay, but you have to respect yourself and your time enough that your time is simply a cost of the work. It's not your profit or your margin or your markup. And you have to add that markup to it in the end, so that that $25 an hour you're billing for yourself is your salary. That goes into your pocket to help pay the bills at home. And then anything else you've attached to it as overhead or profit then goes back into the company. And hopefully, if you're the owner, you can write yourself a check for that at the end of the year too, or through bonus structure. But that's really the what it boils down to, is making sure that your hourly rate is not your profit margin.
I'm going to add something else into this that gets bantered around the internet constantly, and I'm always the first to want to banter about it. But you have a large percentage of people in this industry that feel as if there should not be a markup or margin placed on material, because a homeowner can go and just buy the material themselves. That's a bunch of hogwash.
Mm-hmm.
If I'm going to take the time to go out to the job site, measure the job, look at the job, consult with the homeowner, go back, do my takeoff, price everything up with my supplier or suppliers, and then I'm going to submit a bid to that particular or an estimate to that particular homeowner, you can bet your sweet bippy I'm putting a profit margin onto the material cost. Because I also, if I get that job, I have to go pick up the material at the correct quantities. If by chance I make a mistake, or say a drill bit breaks on the job site and I don't have one in the truck, I have to now stop my job. I have to go to the supply store, go pick a drill bit up, come back to the job. Now there's an hour missed in the job. And then on top of it, the way I always did business, and I think you did too, Steve, was after the job is complete, not only am I put a lifetime labor warranty on everything, but I'm also going to handle the material warranty on behalf of the homeowner if something should arise. So in other words, if there's an issue with, the seal breaks on the glass, for the window, I'm going to walk that homeowner through. I'm going to contact the supplier or the manufacturer. I'm going to get a manufacturer's rep out to look at that window, and I'm going to walk that project through to its end to get that homeowner where they have a brand new piece of glass in the unit.
Yep.
That costs me money. And if you're not putting a margin onto your material cost, you're not getting a true 50% margin.
Now there is a way around that, and we'll get into this a little bit more when we talk about contracts, how to organize contracts and deliver them. But when I was in construction, we always marked up our materials, but my guys in the field, including me, were hourly employees to that job, and so if the homeowner calls you out and says, "Hey, I want to put this window in, but I don't want you to charge a markup on the window. I want to provide the window," and we'll get into that later why that's a bad idea. Let's say that does happen. In my contract, I have going to charge them for the time that my guy and me and whoever else is on the job site is spending doing the job. And so if you're providing your own window, you're still paying me all the project management and overhead it took for me to get the window for you. And of course, if you get into cost plus jobs or GMP jobs, there's other nuances to that. But that's one way to protect yourself from a client homeowner who's interested in doing that. That's a little bit safer in my world for me than simply multiplying by an additional markup, because they're always going to argue with you about that. But like I said, we can get into that in a whole lot more detail in another episode and
Well, and to your point, I mean, I understand in a design build scenario like
Yep.
you were in all your cases, it could be a little bit different. But when
Yep.
you're dealing with a specialty trade,
Yeah.
for instance, a window,
Yeah.
that homeowner does not know as to whether my subcontractor likes his windows tight or likes a half inch around the gap, and he'd rather foam them. He doesn't know that. Um, he also doesn't know all the normal nomenclature when it comes to a window.
Correct.
I mean, what's a mutton, versus what's a grid or a grill, so you have to take all these things into account.
It's called
And
expertise.
exactly, and that's what you're paying for.
Professionalism.
As a homeowner, you're paying for the expertise that actual contractor professional is providing you. And with that comes a properly ordered product that's going to be properly, hopefully, installed properly
Yeah.
as per manufacturer specs.
Yeah.
So, you take all that into account, and I know that you got a ton of homeowners out there that, for one, they think they know everything, and you got to be very careful as a contractor to be working with those particular types of homeowners, first of all. But they're also the first homeowners that will throw you right into the ditch when it comes to costing out the job at the end.
Yeah.
They're the ones that have all your monstrous change orders during the project, and they want to, now the wall's installed. No, I don't like the wall there. Let's move it 2 feet. Well, I don't want to, but I don't want to pay for it. You got to take all of these things into account to make sure that you're, because, for years, 50% is kind of that golden point from a margin standpoint in the construction business. 50% is actually a golden point in a number of businesses from a margin perspective. So there's a science behind it. It's not an art, where, your
math.
company is different than everybody else out there, and you can do it for 30 and you think that you're actually going to net out at the end of the year. It's not going to happen. I can promise you. So anyway, hopefully, this short episode's been of value to you, and please make sure that you ask any questions down at the bottom that you may have from what we've discussed here. It's extremely important to Steve and I that we educate you guys as contractors and trying to make you all professional contractors in the field, that you guys aren't working too hard. You're working smart. And getting the 50% profit margin on every project that you sell at the minimum is working smart. And it's going to make you so, you don't have to do as many jobs to make the same or more money. So as for that, Steve, I'm going to push it off to you and you can close it out.
Yeah, well, you did a pretty good job there with the summary. Again, we just ask everybody to subscribe to our channel. There's a lot of content on here, and we're going to continue to produce content. Please, like John said, leave the comments in the YouTube. If you have questions, we will answer them ourselves personally. And any emails or text messages that might be necessary to help you understand what's going on. We're here for you guys. If you get some value out of what we're doing here, and we hope you do, go to our website and links again here in YouTube, and make a donation to our cause. John and I are not doing this for money, but we do have expenses associated with technology and so forth to run this and make it as public as possible. And so anything you could give to us and to the mission would be much appreciated. And of course, share this video with your fellow contractors. If you have a homeowner who doesn't understand how this math works, share the video with them.
Good point.
We will probably do another version of this for homeowners, the exact same math in it, and be an advocate for you guys as to how this is done. Explain to them the pros and cons of what we just talked about, with them wanting to do their own work and provide their own material. We'll get there, but
let me add something to what you just said, Steve. I know you're closing out, but not only be an advocate for these contractors, but be an advocate for the homeowner as well. Because a homeowner does not want a non-profitable contractor on the job site. When all's said and done, when it comes to warranties and follow-up and everything else, they want a professional contractor out there that is going to be there, instead of in lieu of the old taillight warranty. The car drives down the street, turns around the corner, and the second you see the taillight disappear, that's where your warranty's gone. That's not what a homeowner desires in their project. So, um, this is not only a contractor based portal video that we're doing here, but yeah, we're definitely going to make an emphasis on the homeowner side as well, how important it is to them as well.
And if you're watching this, again, if you push the little bell at the bottom, you'll get a push notification when we release that video for the homeowner side. And go over there and listen to that and see what we're telling them, so that you'll understand what the best practices are that we're advising our homeowners to be aware of as well. And there's a lot to share. So we'll pull this extra credit lesson to an end here, and hope you guys enjoyed what you saw. Like I said, share, tell the world what we're doing, and we'll see you on the next one. Thank you very much.
Don't forget to like our video and subscribe. Leave a comment or question while you're at it. Your support is very important. Visit www.homeprojects.com to donate via PayPal or GoFundMe. Thank you!